So far, we've discussed how to account for assets that we've purchased from someone else, but companies don't always buy their long-lived assets. Sometimes they build them. A retailer constructs its own distribution center, a manufacturer builds its own production facility. These are called self-constructed assets, and they raise the same question as assets that we've purchased, but in a different context. When you're your own supplier, what does the asset cost? Most of the answer is intuitive, but there's one component that surprises almost everyone the first time they see it: interest. While a company may have enough cash to pay for the cost to construct an asset, that isn't usually the case. Usually they'll need to borrow the money to embark on the construction project at all. And honestly, even if they have the cash, it usually makes better financial sense to finance the project rather than tie up all our free cash that could be used to maintain operations. But when you finance something, you incur interest. And under GAAP, interest incurred during construction becomes part of the cost of the building. Borrowing costs, which we normally expense the moment that they're incurred, get capitalized instead into the brick and mortar asset. By the end of this lesson, you'll see why that actually makes perfect sense. Let's start with the easy parts. A self-constructed asset is capitalized at the cost of the materials that go into it, the labor to build it, and a reasonable share of overhead, things like utilities, supervision, depreciation on the construction equipment. That's the same logic as last lecture. Every cost necessary to get the asset ready for its intended use. Now, the interesting one, construction takes time, often years. During that time, the company has money tied up in a project that isn't producing anything yet. If the company borrowed to finance that construction, the interest incurred on that borrowing is just as necessary to getting the building finished as the concrete and the steel. So GAAP says capitalize the interest incurred during the construction period. Two boundaries on this rule. First, it only applies during construction. Once the asset is ready for use, interest goes back to being expensed like normal. Second, it only applies to qualifying assets. Assets a company constructs for its own use or for discrete projects built for sale or lease, like a real estate development. You don't capitalize interest on routine inventory. The calculation comes down to 3 steps. Step 1, determine the weighted average accumulated expenditures. This approximates the average amount of money tied up in construction during the year because expenditures happen throughout the year, not all on January 1st. Step 2, multiply that weighted average by the borrowing rate. And if there's a loan taken out specifically for the construction, we use that loan's rate first. Step 3, compare the results to the actual interest the company incurred during the year and capitalize the lower of the two. We can never capitalize more interest than we actually incurred. Let's look at an example. Suppose construction on a new warehouse runs the full year, January through December. The company makes 2 payments to its contractor, $600,000 on January 1st and $800,000 on July 1st. The January payment was tied up in the project for all 12 months, so it's weighted at 12/12, the full $600,000. The July payment, though, was only tied up for 6 months, so it's weighted at 6/12, or a half, $400,000. Add them together and the weighted average accumulated expenditures are $1 million. Notice what that number means though. Even though we spent $1.4 million in total, on average, we had about $1 million tied up in this project over the year. Now let's look at step 2. The company financed construction with a $1.2 million construction loan at 7%. So the interest we could capitalize is $1 million times 7%, or $70,000. Step 3, how much interest did the company actually incur this year across all of its debt? Let's say the total was $84,000. We capitalize the lower of the two. $70,000 goes into the building account, and the remaining $14,000 is expensed as ordinary interest expense. The entry adds that $70,000 to the value of the asset, which means it'll eventually hit the income statement, but through depreciation over the building's life instead of interest expense today. So to summarize, self-constructed assets are capitalized at materials, labor, overhead, and interest during construction. Interest capitalization applies only during the construction period and only to qualifying assets. The mechanics are 3 steps: weighted average accumulated expenditures times the borrowing rate, capped at actual interest incurred. And remember the intuition. Financing the construction is just as necessary as the materials, so it's part of getting the asset ready for its intended use.